Hey, I'm Matt Hudgens and he's Dave Mulvaney and this is Profitability MD. Dave, how you doing today, buddy?
Doing great, Matt. How are you today?
Life is good. Summertime all around, my friend.
It is everywhere. Hot.
All right, so we got to do this. We're going to do episode 80, Business Owners Stop Tipping the Government. Stop tipping the government. And what I mean by that is there's some stats out there that say 94% of business owners are overpaying their taxes. And overpaying taxes, I like to call tipping the IRS, tipping the government, overpaying your taxes. 94% of business owners are overpaying your taxes.
And if you're one of those 94%, this show is for you because we want to help you. Now, before I say that, I want to make sure that everybody understands we're not giving you tax advice. Seek the advice of a competent CPA, tax attorney, whatever. But we're going to show you some things that are available to you. Some would call it deductions. The reality is it's not just deductions, because if you pay the IRS too much, they're not going to give it back.
They're not going to give it back to you. So I really kind of outline this in 5 steps to like financial freedom. You know, use your business. We talk about this all the time. Use your business to build wealth, right? And so we've kind of outlined some of the 5, which would be, you know, we want to increase your revenue. We did a podcast just recently, 6 ways to increase your profits, right? Yep. Or increase your revenue, I think we called it. We talked about reducing overhead, right? That's step 2. We talked about that in one of our podcasts recently. This is step 3, which is kind of lowering your taxes. We'll get into step 4 and step 5 in the future. Cut your spending and boost your savings. And then we always talk about investing wisely. So tax saving tips that are great for business owners that the average individual doesn't have. And what I mean by that is, you know, if you work at a corporation, XYZ, a corporation, you make money, you pay taxes, and you come home and now you pay for your cell phone and your house and your cars and your computers and your iPads, right? As a business, so then you spend what's left over as a W-2 employee. As a business owner, you get to make your money, pay those expenses, legal business expenses, and then you pay taxes on what's left over. That's the beauty of being the business owner. And that's what I mean by 94% of people, business owners, overpay taxes, is that they don't realize what all the deductions, legal deductions that are available. Again, consult your professional CPA, bring up these ideas. A lot of the CPAs are not as proactive. But the first thing we talk about is now, this was just in 2017, the qualified business income deduction, right? That your business makes money and the first 20% of it is tax-free. That's basically how it works as a business owner. Now, there are qualified and non-qualified businesses, which you talk to your CPA about what's a non-qualified, but most businesses qualify for a 20% deduction. So if you made $500,000, you get a 20% deduction. So the first $100,000 is tax-free.
Yeah.
Right?
So let's pause for a minute before we, just to be clear, if you run your business in the same checking account that you go to Publix with, you're not running a business. So I just want to be clear. We're talking about a subchapter S, limited liability corporation, taxed as a subchapter S or as a C corporation or a C corporation. You're actually running a company legally. You're isolating your funds. You're not commingling funds, which means like doing your personal shopping out of the company account, any of that. So I just want to be clear of that.
And that's perfect. And that's a great reason. If you are a sole proprietorship, you should have a business structure. You should have an LLC or an S Corp. Again, talk to your professional which one's appropriate for you. But you want the business structure because it allows you to take these business deductions more legally or fairly, right?
And those, I'm going to say, here's the difference between a sole proprietor and a corporation. So I know somebody who's starting a pressure washing business. He purchased a truck. He purchased like the pressure washer and all this stuff. This isn't, and he wasn't incorporated. I said, here's what you're going to do. You're going to incorporate this year, because he still has a job. He's doing this as a side business. Incorporate. It might cost you, $1,000. But then you're going to sell all that equipment to the corporation.
Right.
And when you sell that equipment to the corporation, now guess what happens? Because you invested in that company, you can deduct that equipment. So all the money you paid from your W-2 wages, now you might get all of that back. So you're investing into a corporation. And so instead of paying taxes, you'll now have deductions, which could lower your taxable amount far more than it costs you to incorporate. That's what the difference is.
That's the benefit, right? And that's what goes in there. You know, they call that 100% bonus depreciation. So when you're buying equipment for your business, right, it can be depreciable. Now, this is where we get into what equipment is necessary for your business, right? So we use the example iPads. You need an iPad for your business because you do sales presentations with your iPad, which is what most people are doing now. So if you need a new iPad, let's buy it through the business. So the business gets to deduct $1,000 or $1,500. I forget how much they are now. But who's to say you're not also using the iPad at home, right? That you're using the iPad when you travel for work or when you're at home watching Netflix, for goodness sake. But you had a business purpose to buy it because it's what you show your sales presentations on. That's a great example, is an iPad. Laptop computers, right? You need a new laptop because that's what you do your work on, right? That's a business expense, as opposed to if I worked at the bank, I'd have to go buy that laptop or computer with my money after I've already paid taxes.
Correct.
In this example, I actually bought a new laptop just a few months ago over at Costco, and that's a business expense, right? I bought a new laptop. Now I got a fancy new laptop. I get to write that off. That's a business expense. But I also do other things on the computer, but I needed the computer for work, right?
Sure. And then what's important about that, and I mean, it's not really necessary, but it is. If you're at Costco and you're buying all your other stuff, but you're going to get that business computer, just ask them to ring it up separately so you have a separate receipt. So even if you put it on, you know,
keep it clean.
Yeah, keep it.
That's right.
Always try to keep the company stuff separate from your personal, because ultimately the IRS wants to know who, what, where, when, and why. You know, and that's really what they want to know. So if you keep it clean, it's hard to remember if well, let's say you were throwing a company party and you bought a bunch of wine for that company party.
That is all a business expense.
That's a business expense. But if you always buy your wine at Costco on the company card, that's not going to be a business expense. And now it'd be hard to explain why you bought wine for your company party. And you see what I'm saying? You got to separate expenses always so that you can point out and say, this is why I bought it. This is what was the purpose. And by the way, what we're talking about is real money savings. I know,
it's huge.
I know.
We're talking about the next thing we're talking about, like cars. You can buy a car through your business that you use for business purposes. You get this bonus depreciation, so you can get somewhere like $18,000 or $19,000. I forget what it is this year, right? Immediately, you can lease a car through your business that you use.
Now, is the bonus depreciation, Mac? Is that tax code 179? Is that the bonus depreciation you're saying?
That's a different bonus depreciation. Section 179 is really more for your equipment.
Okay.
But the bonus depreciation for the car is a little different, but similar idea where you get to accelerate it, right? SUVs, that's like going through the old farming rule. With an SUV, a car over 6,000 pounds, you get $25,000 deduction right off the bat instead of 18.
So one of the things that maybe somebody might not know when they're watching this. So I don't remember who was the president when they created the 6,000 pound rule, I believe it is.
Right.
They created, you can't fully deduct the vehicle unless it weighs more than a certain amount. It might have been 6,000, might have been 5,200 pounds. I don't remember. But when it happened, the SUV market exploded because they made them like a luxury car, but companies could deduct it. And so, you know, companies make profit. So you get a choice. You can put the profit and tip the IRS, or you can take those deductions and provide nicer things, perhaps for you and your employees, et cetera. So
exactly right.
And shareholders, certainly.
Right. Electric vehicles, right? If you wanted to buy a new electric car, you get a tax credit for that. I don't know if it's still $7,500. It used to be $7,500. Retirement plan contributions. This year, actually, the new Secure Act says if you're a business owner and you started a new retirement plan, I think it's like $5,000 tax credit that you get for starting a new retirement plan. You get to write off the cost of starting the plan itself. You get a tax credit for starting the plan itself. That's a really good one because you want the retirement plan for yourself as much as you would want it for your employees. Retirement plans are fantastic.
And while we're talking retirement plans, So what do you do with a lot of these tax savings? You might want to think about putting them into your retirement plan so that you're not just like spending it, because what happens is time goes by very quickly in business, and 20 years can go by. But if you just take your tax, instead of, you stop tipping and you take those taxes and invest it in your retirement, invest it with people like Matt, then before long you accumulate a lot of, a nice retirement fund.
Yeah.
Which
And that's what we're trying to do is you build the wealth by, these are some expenses that would be, you need a car for your personal use, but also for your business use, but we can write off a portion of the car. You need computers and laptops and iPads for your business. So we can write those off, but we'll also use them for a computer. So what you're looking for is the business expenses that are legitimate business expenses, but I can also get the benefit of using a personal car. Like you just said, the car, hey, we need a new SUV. Well, gosh, that could also be the SUV you take to the beach, right? But you bought it for the business purpose, right? So these are trying to convert what you would have. How do I say this delicately? These are business expenses that also happen to have a personal use benefit as well.
Well, for
instance, we used to talk about your cell phone. Like, remember, like your cell phone, you're paying whatever it is, X dollars a month. The IRS lets you write off the cell phone. They don't ask how many of those phone calls were personal or business. You see what I'm saying? It's just one monthly payment.
Because what business owner could not,
operate without a phone,
without a cell phone? It's it's one of those things. You got to have, what business could operate without a computer? So what does that mean? Well, when you go home at night and you have a place that you sit down inside of your office and all you do is do work at that desk, even a portion of your square footage in the house, if provided, now the tax code says provided you use it for work purposes only, you can deduct that portion of your house.
Yeah. Now it's set at $1,500 a year.
Yeah. So
they made it simpler. It's $1,500. If you have a home office, you get to write off $1,500 a year. It's awesome. We talked about it a little bit, like the structure. You mentioned that earlier. You might do an LLC, you might do a subchapter S, but there are reasons that you have these structures. Again, talk to your CPA that might help you reduce your payroll tax on your own personal income, the 3.8% we pay on personal income tax, because you could have a salary and then the bonus is what we call a K-1 distribution, right? In an S corporation. So your salary could be this, and then your profit distribution is that, and you don't pay the payroll tax on the K-1.
Well, it actually comes out to 15.3% when you calculate. If you're the employer, you withhold 7.65% from your employees for Medicare, Social Security, Medicaid, for that portion, and then the employer matches that. So if you're the employer, rather than paying yourself regular wages, now I do recommend highly paying yourself regular wages. Why? Number one, look what happened during COVID. A lot of employers who weren't paying themselves regular wages had no access to PPE money because they were not paying themselves regular wages. So that can be a detriment, I guess, to your business. So
this is one of my favorite rules. One of my favorite rules, the nickname is the Augusta rule. So the Masters happens every year in Augusta, Georgia, and people rent out their houses, right? So the way the rule works is you can rent out your house, your personal residence, or your vacation home for 14 days per year and not pay any income tax on that. Okay. So what happens is the guys in Augusta, they rent their houses for $10,000 to $15,000 for the week. The pro golfers come in there, the media come in there. They don't have to claim that $10,000 to $15,000 or get it tax free. Now watch this though. This is how a business, and this is like one of my favorite rules. This is how a business owner could use that rule, right? That you host the Christmas party at your house instead of the country club. So you could have the business pay you rent for your house for that business party. You could have staff retreats. You could have shareholder meetings. You could have staff training. You could have director meetings all at your house. And each time you could have the business pay you, pick, whatever the comparable rate is, $1,000 that it would be for an all day renting a conference room somewhere. You could write that. Now all of a sudden you created 14 training days at your house, your lake house, right? So we're doing a corporate retreat up at my lake house next weekend, or not. I'm just saying we could. And then you could write a check from your business to your lake house or to you personally and use that tax-free because 14 days of income is tax-free. And you could have a corporate retreat up there. You could have the party at your lake house. You could have clients up at you could have prospects up there. You could have, like I said, staff meetings, shareholder meetings, director meetings. The Augusta rule, it's called Section 280A, I think is what it's called. But the nickname is Augusta rule, where you can rent your house or vacation home 14 days a year tax-free. How do you really do it? You do it by hosting your own staff or your own prospects, your own employees. That becomes a business expense. So let's say it was just 14 days at $1,000 a day. That's $14,000 that would be, you're not paying income tax on, but you would receive it tax-free income on your personal side.
And, you know, all this boils down to the more, let's just say the more profitable your company is, the more these things are available to you. You have a choice. I can write the biggest check possible to the IRS, or I can use some of these tools to, I want to be cautious about saying improve my lifestyle, but ultimately that's what you're doing. That's why you're self-employed in the first place, to be profitable. I'll give you an example. You see all these people flying either first class or flying private. Well, why are they flying first class? Well, because their business is profitable. They can either sit in a nice seat and deduct that so they don't pay it in tax, or they can pay it in tax. Well, why not sit in the front seat? Other people will sit in their own plane because they have the choice. They're so profitable, either pay it to the IRS or fly private and have all the conveniences. I mean, certainly you have to justify why you would fly privately, right? At $25,000 a segment, that's fairly expensive. But so you get on a plane, instead of going from Jacksonville to Atlanta to wherever you're going, you could get on a plane in Jacksonville and be at your destination in 2 hours. Think of all the time you saved and flying back. And that was your justification for spending that. Massive amounts of tax savings, but yet you were able to be more efficient and be more profitable because you had more time to do it.
Yeah, exactly right. This is a great one too, talking about try to tag on personal travel with business travel. And so I was actually just talking to one of my lawyer clients earlier today. The lawyers have a annual retreat down in Amelia Island. I think it's like a 3 or 4 day conference. So of course they bring their family with them, right? Because they're at the conference. But their family can stay in the same hotel room or condo that they rented. Yes?
Yes, correct.
I even have lawyers that will stay the whole week and have a corporate retreat. So let's say you and I are lawyers and we own a law firm together. We're going down to this Amelia retreat anyway. So we're going to write off those 4 days, but we're going to stay an extra 3 or 4. And you and I are going to have a director's meeting, a shareholder meeting, because we own. So now we've written off the entire week of the beach vacation. The family was here for the week, but you and I were doing business because we were at the conference, and then we were having our own daily strategic planning meetings. But the family got to enjoy the beach house for the entire week, and we would write off the entire week of the beach house, or whatever percentage portion you feel comfortable with. Talking with
well, yeah, you might not write off your spouse's airline ticket or any of that. You're not going
to write off any of that. No. I'm just talking about you rented the house for the week, for the conference, and for your strategic planning meeting with your partner, but it's got enough room for the family to stay too.
Precisely.
Right? You could also write off, we talked about travel, business meals, business car expenses, tax return fees, safety deposit box rentals, dues and subscriptions, continuing education, investment expenses.
Can you pause on the dues and subscriptions?
Yeah.
Like a country club membership, is that deductible?
I can't do any of that. No, country club memberships are not. Dues and
well, I was just asking that for a
that's a great point.
reason, because people might ask if you said subscription.
That's a great point. No, it's not dues. They specifically eliminated country club dues as an elimination. Dues meaning more to like memberships to the the association that you're a member of. The mortgage brokers association. Those kind of dues is what I mean. But here's continuing education. I had a dentist who did all his continuing education in Hawaii. Okay. We just talked about continuing education. You could do like in Amelia Island, like the lawyers do that's a conference, but it could be continuing education. So especially doctors have to get continual education. You could do your continual education in an exotic location. There are conferences for dentists that are held in Hawaii, that are held in the tropics, that are held skiing, right? And there's a certain percentage of how much of the day needs to be in the conference, but it's not all day. So you could go have the conference and then you go skiing in the afternoon. the conference and then go to the beach in the afternoon, right? So there are a lot of companies out there actually that strategically organize their continuing education in exotic locations. So
I used to put on a company event every year, and we did Amelia Island Plantation, but we also, part of the event was, you know, we'd have 2 days of training, coaching, training, you know, but then we also had a round of golf, you know, as a group, and, you know, that's all part of the event. And again, all the food for the event, all of that stuff, you're putting that on to grow your business, right? Because you're bringing salespeople in or whatever,
right.
or your employees or whatever. It's all to grow your business. It's all tax deductible. I shouldn't say all, because food and beverage now is
golf is no longer tax deductible.
Yeah.
So now with the way that the conference centers get around that is they include the golf for free. They'll charge you more for the food and the rent of the conference room, and they'll give you the golf for free.
Yes.
Ticket people do that too. Ticket prices are no longer tax deductible. So they'll do a marketing and advertising, and then the tickets are free or a huge discount. So, but you used to be able to write off sporting tickets. Can't do that anymore. Talked about disabled access tax credit. So you can make some improvements to your office building that will make it more accessible for the disabled, such as expansion of the hallways, repaving the parking lot, installing a wheelchair ramp, ADA compliant bathrooms, which could also mean you make the bathroom nicer, right? All that can be, you know, new carpet, floor covering. Let's say you want a more solid surface tile. We could call that, it's a $5,000 annual tax credit for making improvements for disabled. You could take advantage of that with your own office building.
So we've covered like a lot of ways that you could save like a ton to stop tipping the IRS. I know there's more, but
there's like 50. We're only like 20 through 50, right? I've got a whole list of 50, but you get the idea. The point is, use your business to quit tipping the IRS. Use all the business expenses that you possibly can to get the most use, the biggest bang for your buck for your tax dollar. But that also goes back to our whole theme here, which is make more. We'll teach you how to make more in your business. We'll teach you how to pay less in taxes, right? These are the things you and I talk about in our mastermind group, right? 6 ways to grow revenue, right? 6 ways to increase profit. Now we're talking, 50 ways to decrease your taxes, or how do we say that? Stop tipping the IRS.
And
right?
do not overpay your taxes.
Not overpay your taxes.
Way to
right.
look at it.
And then all this leads also, we like to teach our guys in our mastermind groups how to take more time off, right? Take more time off, because we did the retreat we went to the conference, and then we did the strategy sessions with partners, right? So now we could have 4 of those a year, right? They could be in Hawaii. They could be in, these are all going back to things that we teach in our mastermind group, how to make more money, take more time off, and pay less in taxes, right?
And keep more. Keep more.
And keep more of what, yeah.
You want to accumulate wealth over time. And that's ultimately what we're all here. We want to eventually, what's the time off? You want to have time off and the money to enjoy that time off.
Yes, exactly right. So we're just trying to give you some tax savings ideas. Again, talk to your tax professional. But the point is, these are the kind of things you learn in our mastermind group. You and I are doing a mastermind group. You want to apply to that, please send an email to Matt at profitabilitymd.com, Dave at profitabilitymd.com. We're interviewing people now for the mastermind group. And the idea is we're taking this podcast and applying it directly to you and to your business, and teaching you how to create the business that you deserve, right? To make the money that you deserve, to take the time off to enjoy with your family that you deserve, and to keep more of what you earn by paying less in taxes, right? This is what we learn. This is what we teach, in the mastermind.
Yeah. And we'll help you, go through it. And again, we've said CPAs a couple of times. Here's the reality is, if your CPA does not know, like,
some of these ideas,
all these deductions, then you go to them and ask about them and make them study because you should have a CPA who is, I don't want to say aggressive, is the wrong word, who understands the tax code and allows you to take every allowable deduction. You should pay the IRS 100% of what you owe them, and not a penny more.
Not a penny more. And that's exactly right. if you really think about it, the tax code is written for business owners to benefit, for business owners benefit. The tax code is written for business owners benefit to allow deductions for business expenses.
And the reason they do it is because business owners are the producers, and what do they produce? They produce jobs. They produce money for the for everything. And so because of that, the government, every government on the planet just about gives incentives for the producers. It's not a bad way of saying it, because those producers, if they are given a certain amount of profit, they're going to say, hey, I don't want to do all the work, so I need to hire some people. And that's the way the economy works, is those people are given incentives, will hire people, and those people who are hired, they buy cars and other things. But ultimately, giving the employer the incentives is done because they are producing jobs and they're producing revenue for the environment.
The tax code is written. The tax code is written for business owners. Let's take advantage of it. So, like I said, this is what we're doing in our mastermind group. Tell us what other information you want to learn. What information do you need to want to participate in a mastermind like this, right? We're trying to tell you, we think that most business owners want to make more money, take more time off, and keep more of what they make, right? What information do you need to make that decision that you'd like to be a part of this group? Reach out to us, Matt at Profitability MD, Dave at ProfitabilityMD.com. Let us know what information you need to commit to a mastermind group that helps you make more, help you take more time off, and helps you keep more of what you make. All right, man, where can we find Mr. Mulvaney?
Well, you can find Mr. Mulvaney at davidmulvaney.com. You can connect with me on LinkedIn, David Mulvaney. And of course, you can find our podcast at any place you listen to podcasts at Profitability MD is the podcast name. Find us at profitabilitymd.com. Our YouTube channel is Profitability MD. Where can we find you, Matt?
Yep. So over at LinkedIn, Matt Hudgens, over at LinkedIn, and then 10xprofitblueprint.com. But again, really, it's Profitability MD. That's what you and I are talking about. Profitability.com, profitabilitymd.com. That's what we're talking about. Come reach out to us. We're doing this mastermind group. What do you guys need in order to join a group like this? That's what we're here for. We are doing this because we love to help people create the business that they deserve to have.
Exactly. And create the life that they want.
The life they want. All right, man. Be good.
All right, man. Take care. All right.